Test. Testing. Testing. Okay, we're live. Thank goodness. Okay, we're live. Thank goodness. All right, what's going on? It's Tuesday morning. I am streaming here about 8 minutes late because I couldn't get my audio to work. The streaming software had to reset. So that was fun. Um, but anyway, we're gonna finish the lending model today. Uh, as you know, I stream every Tuesday morning at 9 a.m. here on YouTube. Don't forget to subscribe. This is a time when people could come and ask me for any questions, ask for customizations for things in the past, or ask for new models to be built, or talk about whatever while I'm building templates. So today, I'm hopefully finishing this. It's been 5 weeks, I think, 4 or 5 weeks that I've been working on this model, and it's going to be done. We'll do a quick overview. It's a model to plan out your if you're lending money to people or if you're essentially a startup bank and you want to plan out the capital requirements to lend out money loans over time with different metrics. I did 3 different loan types. You can do interest only with a P&I period or interest only period with a P&I following, interest only loan or a P&I only loan. And you can plan out how the count of those over time, how many um, are originated per month in each year, uh, what the interest only period is, weighted average interest for the interest only period, interest for the P&I, the term in years, the loan amount, and origination fees. So uh, all that was very difficult to build. It took about, you can see here, I had to do some matrix stuff over 800 rows worth of logic to make it work. It was very difficult. Um, and I did that all live. So that's done. You've got a monthly and annual detail that goes through all the metrics, loans added, consolidated, the cash requirements, money getting paid back, money going out for the origination, principal repayments, origination fees as revenue, uh, all three revenue and origination fees for each type, cost of goods sold. Then we got OpEx, G&A for if you're doing operations. You could just do it if you want to participate in a like a lending club type of situation and see what you might be able to earn and how much money you're going to need to do that. And you can zero out most of the expenses and just plan out like the loan rollout and what you plan on doing each month. So I think that's really valuable. I haven't seen any other scale models of loans because it's just really hard. Uh, then I decided a couple weeks, 2 weeks ago, to build a three-statement model on top of this, which was very, very difficult. And so last time I was doing this, I had the equity requirement as a hard-coded input. Now it's defaulted to the minimum equity required, including essentially any net income or profit is going to be reinvested back into any loan requirements. And then as soon as you get to a point where you're positive as far as the cash flow, so as soon as this net change in cash, if we go over, starts to become positive, so here it's in month 44, um, now now there's distributable cash flow. But until then, even though there's net income from net operating activities as positive, this is being used to lend out more money. And then it's actually not coming back as a return on investment until the amount is greater, the net income is greater than the capital requirement from lending out plus, anything else going on here. Uh, this is like a long-term loan if you want to use a loan to finance the operations of this startup. Um, but that can be zeroed out if you're just using all your own money. And then principal collected from borrowers who are making repayments versus disbursements given out to make new loans. And if the net of all that is positive, then we now have distributable cash flow, and that's used to calculate the project's internal rate of return. Until this gets positive, no cash, you can see on the distribution detail, no cash is returned. And you've got your equity requirement, which is how you get to. This will basically show you your cash balance on your balance sheet is never goes below zero. You can see it's right here at zero, and that's defaulted to happen no matter what you put in the assumptions. Um, so this was very difficult to build out, but it works. We've got the exit valuation, which is just based on the net assets at the exit month. So if we do have an exit here, let's say December 3rd, 2030 is a 10-year model. Let's distribute excess cash, yes. Um, the valuation is 34,900,000, which is if you go to the balance sheet, that is, and go all the way to the end, that is your loans receivable. So all the loans you've given back that you haven't been paid back yet, that's essentially the valuation of this. And you can sell that at some multiple or just a 1x. Um, that's also going to be the value of the retained earnings plus your common stock, or essentially the money that was put in, paid in capital by owner or investor. So that works fine. You can also account for any seller fees or anything with the exit valuation here to get a net terminal value. Also on the exit month, you can see if we go back over here, this loan balance 520,000 is going to be reduced off of the distribution, which is this number here, net exit cash distributions. And you can see it's doing monthly tail DT 289, which is the valuation, plus if it's the exit month, then take the balance sheet DR13, which the DR13 is any current cash. Now that would be if there was a lot of burn at the beginning, or no, if there was like a giant, let's say in this scenario, there's like a $2 or $3 million capital expenditure after you've already hit the minimum equity requirements, then there would be a negative cash balance here, and then that negative would be summed up at the exit to give you less. So it all balances out. Um, let's go to, I'm just trying to show you real quick, the exit valuation is taking the debt off. So if I go terminal value, you can see it's doing control tab D36 minus DT288, which is the sell rate above it, debt repayment. And then the control tab D36 is this net value, which is just assets against any seller fees. So that's the whole thing. This excess cash deal is, if you hit yes, then it's going to distribute. If we go to the distribution, it's just essentially going to follow exactly with this top distribution, which is doing all the equity requirements are up front, and then as soon as you get to that positive net cash flow, you start distributions. Here, you can actually see if you don't want any distributions, then nothing is distributed at the bottom on the bottom row here. This is its own separate thing, except for at the very end, and that has its own internal rate of return. Now, the reason why you may want to do that is to see how much cash builds, and if you don't take any money out of the business, so you can see you get up to 14,800,000 in cash on the balance sheet. You got this as your debt, long-term debt, and then your equity. And what this means is you can see the difference in the project if you distribute all available cash flows that are above the um, net capital usage, I guess you could say. And that's that versus collecting it all at the end. What's the difference in the rate of return? So this is separate from all of the. It's using the same numbers, but this down here is able to be essentially shows what happens if cash is not distributed till the very end. All these assumptions you enter will affect all of these numbers. Like if I start doing bigger loans, let's say 20 a month, or not bigger, but just more, then you'll see real quick the capital requirement is now up to 38 million instead of whatever it was before, like 27. Let's see, what was it before? Yeah, 27. So all of these assumptions are going to affect the final results, cash distribution. I did add a default rate as well that applies to any principal collected. That'd be an expense because you're not going to collect 100% of your loans you paid out. Okay, so now that everyone's caught up on what we're doing, let's try to finish this. So what we need to still do is the annual income statement, balance sheet, and cash flow. Now this should not be as difficult. I'm just going to be summing up values. So we're going to move kind of fast here. I'm going to try and finish this up and then do visuals, and then we'll be pretty much done. So income statement, to do this, we just want to create income. We're just going to actually do IS annual, so we don't take up too much. So on that, we only need 10 columns. Don't need this. Wait, is this the year? I guess it doesn't matter which one. We'll just use this since it's in. So this is year ended. I think that's what we named it. Let me pull up my three statement model template. Let's see, what did we do for the yearly? Year ended as of year end. Year ended. Okay, got it. So we should be able to sum up most of these with sum ifs. Let's just do a sum if on the origination fees. Sum if 7 if the year matches. 3 matches the year. Okay, cost of goods sold. Definitely sum that up. Oh, wait a second. Yeah, actually, yeah, that's fine. Sum all this up. And wait a second. What am I So for taxes, monthly detail. Okay, so I did automatically do taxes based on the annual detail, which is manually input. And there's so many variations in taxes. So what I did is for this part, you're just going to manually input what you think you'll be paying in taxes each year, which will change depending on the situation. Like here, if these are negative profit, you're not going to be paying taxes. Um, but there's just so much to account for there. It's easier just to make it an input for the user. So let's see, we can sum up this based on the same thing. What's up, viewer? Welcome to the stream. We need to make sure, okay, so we're done there. Let's make sure the net income matches the net income on the monthly. 26,062, 25,821. So that's off, so there's some difference there. Let's see. What are we out by? These are always important to do sanity checks to make sure your numbers are what they should be based on the logic. So 241, what could that be? Oh, interest. That'd be that. That would be that. Now we should be balanced. Perfect. All right, so now we go to the balance sheet, annual. This might get a little bit trickier, but we'll see. We'll go BS, annual. Again, here we only need 10 periods. And this will be as of year end. Now, let's think about this. So cash flow, the end of the year one. Oh, let's format the dates real fast. So these are going to be for years, not months. So cash at the end of the period would be balance sheet. I guess we have to kind of start, well, we could do a formula. Let me think how this, let me put the year or the month ended at 1 month prior so I can make sure this works when you don't go all the way to the end. Okay, so that'll just zero out. So we should be able to do an index on here and just pull the balance sheet cash amount. If we match the end of the year, so E-date this, comma 12, or no, I'm sorry, comma 11. And then that should be that. Now, hold on. This equals E-date this, comma 12. And I'm assuming, right, there's no, so if error, then 0, and then we need to lock some stuff here. Like this, and this. Also, our income statement, I'm assuming, yeah, we got to update the format here. So this is just, so we got 10 years, no errors. That's good. Now I should be able to just drag this down into here. Now this won't technically give you the perfect number because if we end in year 10, it's going to say the end of year 10 is 0. But in end of year 9 is some number that could be different. It's okay though, because this is just year-ended balance sheet. So is doing the best it can. And it still gives you a nice view at the end of each year, which is useful. All right, so I think, wow, this is actually pretty fast. We might be done here quicker than you think. So that's fine. That sums that. Retained earnings. Now, yeah, same calculation. So annual turning monthly three statement models into annual is pretty easy. The income statement is just going to be sum ifs against what the monthly is. The balance sheet is just does lookups at the end of each year what the value is. And then all that should balance. And then these are all just plus minus formulas. Check. Okay, balance sheet's done. Cash flow statement. Again, that's going to be super easy. We're going to sum up everything with the sum ifs. Then after this, we're going to do visuals. And then, man, I can't believe we're going to finally finish this model after 5 weeks. This over here. Call it cash flow annual. Go 10 periods. And what's going on, viewer? Welcome to the Lonely Financial Modeling stream. We're doing fun stuff over here. Where's my sum ifs? Actually, we'll just have to make it. So this is just summing up all of this. If the year matches the year on here, lock, lock, lock. It'll be real interesting if I break even on this one, depending on how many hours I make, how many people end up actually buying this thing. It's a doozy though. Really one of the best things I've ever built. Really cool here, all the logic. Always loan stuff, every time you do loan stuff and you're trying to scale it or do timing with other things is always just very difficult. This should match exactly. And wow, we're done with that. Okay. So we've done our, let's just change this to, it equals the same as the annual income statement, year ended. Balance sheet, yep, that looks good. Okay, so all of that's done. The distribution's done, discounted cash flow analysis. I do want to do a quick cash flow, discounted cash flow on if you don't distribute cash for, like in this scenario, if you hit no here, it's saying that all the cash is saved and you don't give any of it out until the end. And I think this could be kind of interesting. So if we do, let's see, the period here, the value that we're discounting down here, and the discount rate is where, oh, right there, that's what I thought. This one, drag that over. So if you're discounting at 6%, in 10 years, 52 million is worth 29 million, and then net present value is just the sum of the discounts plus the initial startup cost. And you can see here the internal rate of return of 6.9%. If we were to put that into the discount rate, it's going to make the net present value zero because that's literally the definition of what the internal rate of return is calculating, which is the rate that makes the net present value of the future cash flows zero. So you can see that turns zero if we popped it in there. Okay, so we got that. Give this a space. Yep, now it's the fun stuff. So visuals, we can kind of see what's going on. That's going to be kind of cool to build. Let's give these the right blue text color. Uh, so visuals. Make that the same as the distribution stuff. So first we'll do some, well, usually I put some on the distribution tabs as well to see investor versus cash flow. We just don't have a whole lot of room, but let's do it anyway. We just put it over off to the side. I try to keep it pretty simple, just so we got cash flows for investors. We got cash flow for the owners. And then we got the periods. Now formatting. -30. And we want this to be low on the axis. We'll do a title and a legend. Oh, hold on, what happened? That should not be, what did I do? So for this one, oh, the label should be here. And then this should be this. There we go. Oh, so chart title. Access title I don't need. So investor versus owner cash flows. And this will all change based on what's input on the assumptions for each accordingly. So if I said, well, the investors are giving 18 million of this, let's say they give 25 million, and I'm going to give them only 50%. And then the owners have to come up with the other 2 million, but they're operating the whole business. So then you see the numbers differ. The internal rate of return is now barely positive for the investors. What is positive, net present value is negative at a 6%. If the discounted cash flow rate or discount rate's higher than the internal rate of return, then the net present value is going to be zero, which is interesting, I think, to know how those numbers kind of relate to each other. Let's say they get 75% of the cash. Now if we go over here, now they're up to 5%, 5.2% internal rate of return. Now, if you did exactly the amount that they're getting back, like if they give 75% of the cash and they get that much share, then the internal rate of returns will be exactly the same for investor versus sponsor. So if I did this divided by this 92%, you could see, go over distributions. Look at now they're exactly the same internal rate of returns because it's just pari passu. Now the reason why you don't do pari passu is because generally the investors are not doing any the owners are doing all the work. The investors are just giving money. So there has to be some difference in the return on capital if the owners are giving capital. So usually that means that the investors will get um, some number less than pari passu as far as their distribution rate, and they're giving up that return since the owners are doing all of the work, and these numbers are all negotiated. I did want to check one thing. Oh, also the customer service and sales reps do scale with this model as it's based on the total loan counts over time. If you're trying to scale up a bank essentially. What did I want to do? I wanted to adjust something here. Oh, let's put if there's no exit, and I want to make sure all of this still balances out. So if there's no exit, everything should be going to the end. Okay, perfect. So we're balanced out. Uh, let's distribute cash. So balance sheet should have zero. Perfect. Perfect. Okay, that looks good. Okay. I just wanted to test to make sure that works if there's just an NA, which it does. We'll put it back to December 2030. Man, I'm really excited about this model. It's really, really awesome. Okay, to match that color. Now, let's get this chart formatted. What looks the best? I think this one. And then we'll give these guys a different color. Let's do like a green. Do a gray outline. Or gray with a black outline. Okay, perfect. Now for the visuals, we'll do the same format, but it's going to be different numbers. So we want to see most likely, let's go to the, oh shoot. Okay, hold on, hold on. We have to do an executive summary, which is going to be a roll-up of the major line items like revenue, cost of goods sold, G&A, S&M, all the cash stuff. So this will be a quick view of everything that's happening without having to go through the detail of like all of this stuff. Let me get a template out for that one. So executive summaries. I'm sure I got one on this. Perfect. So bring that over. Alrighty. Remove our grid lines. It's going to be drug out for 10 years instead of 5. This will check if we're matched up with the annual detail column width. Okay, so we'll show the year-end loan counts. I think that's a decent number. Month-end customers or year-end customers. Let's update our date. I like the color. We can keep the color. That's fine. All right, so total revenue, we're gonna do interest versus origination fees. So let's come down here a little bit. So I want to show interest revenue and origination fee revenue, and then sum up these. So there's interest, and then here is origination. Cost of goods sold, just its own line item right here. Gross profits, own calculation. G&A, we've got right there. Sales and marketing. Research and development. Total expenses, EBITDA, discounted debt service coverage. It's actually kind of an interesting number in this model. All right, so let's go now to other cash items. So CapEx. Debt service would be here. Startup costs right there. Exit value, we're going to be doing terminal, this one. Loan proceeds, that. Loan payback, that one. And equity, if we're going to do, it's going to be this. If we're going to get to the actual cash position. Okay, now on the annual detail, we actually didn't get into, and you can see how this is a nice check between the cash flow statement matching the cumulative cash flow on the annual detail, which that should always match at the end. So this is before equity. Here on our executive summary, I think we'll remove this. So we just should match our cash flow before equity on that. Well, what we don't have on here is, what I'm going to put on here now is loan, which is unique to this type of business, loan disbursements and loan repayments. So This is money going out for loans, which we have here. And then collections. Now, minus, so disbursements 34 is actually got to be a minus, but then you add back any collections. So 25,650,000 is the number we should be at, which, oh, we're at 25,821, so slightly different. Let's see, what are we out by? So this minus this 170. So what line item is that? Oh, taxes, maybe. So taxes would be 350. We need to put taxes in here, so that means we're off by something else. Taxes minus this. 520,000. Oh, is that debt repayment? Yeah, debt repayment. So that's in here. We must be double counting it somewhere. In the exit proceeds, we must be double counting it. So this 34 million in the annual detail is already counting this. So if we clear this out, it should match, which it does. That makes sense. Okay, so that's fine. Okay. We'll lock this here. These can come over a little bit. Now, here's our project level summary. So, oh man, I didn't bring over the owner. So let's do it here, owner. All right, so project, we got to reference these. So the project internal rate of return is that. Equity required is this. Projected return is this. Equity multiple and ROI. So that's good. Now investor, 4.5%. Equity is this. Cash returned is this. And then these are fine. Owner, internal rate of return is here. Equity requirement, this. Cash returned, this one. Okay. So that's good. Let's do our visuals. Drag this down a tiny bit. Select data, so total revenue. Let's do a stack column for this. So revenue. What's going on, viewer? Welcome. Do that one and origination fee. That's kind of cool to see over time. This needs to go through the whole 10 years. Okay, we'll make this a stack column real quick so you can kind of see the total. We don't need to see labels. We do need to see a legend for what's what. The bottom, we also want to see a chart title. So revenue by type, and then it's a stacked, so that's actually the total revenue of the whole bar. It represents the total revenue made in this case. Do I like the color? Maybe do something. Ooh, kind of like that one, gold and purple. EBITDA is definitely just straightforward, and we'll keep that calculation, but let me change the data. So EBITDA is when you actually, what's your actual operating profit? And I mean, I guess we could keep the label since it fits. Let's put a shape around it. That's not too bad. Maybe make the font smaller. Go 7. There we go. I like that. Okay, let's do outlines on these. And this here. Okay, so we've got our project summary. Put that right at the top. Like a little light gray. Make sure there's no references to any workbooks. Now, what I like to do, especially when you're transferring data or using other workbook templates or something, it's always good to do a search, find, go to options, go to workbook, and search for .xls, and that will tell you if you've got any references to any other workbooks, which is very bad if you do. So I don't have any. That's perfect. Um, okay, so executive summary is done. Now we can go into some general visuals. So first thing that I like to do is with this is do the revenue. Um, Actually, we could do it off of this. So I like to show total revenue, basically operation stuff, cost of goods sold or gross profit, actually, and then EBITDA, as well as cash flow. And we do each year. I also need to change this. This is cash flow, just cash flow. Before equity. Flow. All right. Now, so how does this look? Um, we need it wider for 10 years, that's for sure. This is your big first year requirement, and then less and less, and then you start getting positive cash flow. Now the exit, do we get our formatting correct here? The exit, ah, that's why. Let's say no exit here and see what it looks like. So 2030, why is there no other expenses or anything? We must have the formatting off by something. So that's fine. Ah, yes, so this needs to go all the way over to year 0 since we're doing that for the cash flow. Chart formatting can be a little bit of a pain if you haven't done it a lot in Excel, because you never know. Okay, that's good. There we go. All right. So, I'm trying to think if we need to put zeros here. Whoops. Undo. Perfect. Um, I wanted I don't know if we should do a line chart. Bold that. This is operating activities per year. So revenue, cash flow near 0. This is not terrible to read. It's just, I don't know if we want to put it into a line chart or not. I guess this is okay. Let's go now to, and what's up, viewer? Welcome to the Lonely Financial Modeling stream. I'm trying to finish up the lending model here today. We've got it all done. Monthly and annual details, executive summary distributions, all the income statement, balance sheet, uh, cash flow statement, annual and monthly is done. It's been a doozy here. We're super happy with it. Now we're just doing some fun visuals. So we did one on revenues. Let's do one on the costs. So if we go cost of goods sold, for 10 years, we can do expenses, G&A, and this will be a stacked column. We'll go G&A, sales and marketing, research and development. And I think, guys, the next model I'm going to do is something with a generic inventory thing where you can just see the proper way to account for inventory in a three-statement model. I think that's useful. Now, if we stack this, change chart type, stacked. So that should be our total outgoing. Let's see, does that make sense? Year 26 is 900,000, which, let's see, gross 300, 5, 6, 7, 8. Yep, about 900. That looks good. So it should mirror this. 3, 5, 7. Oh, wait. This is only 200 the first year. What are we missing? Cost of goods sold. We don't need to go all the way over. This just needs to be this. Formatting is such yeah, okay, now perfect. We'll zoom out on this a little bit. So we got operating activities, we have um, operating costs. Now we get into more fun things. So you've got, let's look at, let's see the next thing we've got that could be fun. Let's do a monthly detail on, we could do borrower. Hmm. We could do lent amount versus principal repaid. That's kind of interesting on a well, we definitely do it on a consolidated level, but we want to do it on a granular level for each loan type is the question. So lent amount, principal repaid. That's kind of interesting. Let's see what this looks like. So actually, we're gonna go, shoot. We want to go total outstanding loan amount. And this is where you'll see the effect of why we had to do all the matrix tabs and everything. So total outstanding. Oh, that's kind of cool looking on its own. Put it on a monthly. We don't need this. Loans receivable type 1. So that's, you kind of see the scale up, and then as they start to get paid, but you're still adding some, and then when you kind of level out, and then you hit stabilization, which is you're getting paid back the same amount that you're lending out, that you've lent out in the past, which follows this here. Now, if we started, so I did 20, let's go back to 10 on this, and then now you got a smooth curve. If we increased, let's say you started with like one loan a month and then did like three and then eight and then 10, yeah, then you see a little bit of a low and then a steep ramp. That's kind of cool. I don't know if we want to stack this with other things. Um, like I could put a secondary access and say, here's the loans outstanding. Here's the, like a line chart showing the loans, the repayments. Let's see, let's do a second one. Let's see what it looks like if we do, let's see if we do, for type 1, lent amount versus repaid amount. So amount lent per month, and then principal repaid. Interesting. Interesting. I really just want to try to capture the essence of the assumptions and make it really nice and clear what's happening. Let's make these not bar charts because that hurts my eyes. Make them lines. So put a legend here. So for type 1, this is saying monthly loan disbursements versus repayments. And then is there like a net? What else could be good here? Lent amount, principal, outstanding, we get that. I guess it might be cool to overlay the interest earned onto one of these, um, based on outstanding loans. Maybe that let's do it to this one. So select data. Let's add interest for this. See what that looks like. Okay, wait. Is it the exact same curve? Let's try and do a combo. Interest on this axis. So it's literally the exact same shape, which makes sense because it's based on the amount lent, and it's the same, like the terms scale the same. But oh no, here's why it was only like up to 140,000. This is like 20 million, so you probably couldn't. The line was like way down here, you couldn't see. So this is good. Let's do some axis titles. So this is interest earned versus outstanding versus loans receivable. And then we don't need this, but we do want a legend now. And so we're going to show this on for type 1, 2, and 3 loans, as well as on a whole. Now the consolidated basis is going to be cool because that is all 3 loan types combined in the full effect. So that's going to be interesting to see. So this is total outstanding loans receivable versus interest earned. Okay, I really like this. I like this. Um, Now this one, monthly loan disbursements versus repayments. So this is money going out, money coming in. And then the net effect would be your net cash flow of that activity. And as soon as, and you see it stabilizes here when you're actually lending out as much as you've, essentially this is when the scaling stabilizes. Here at the beginning, you're lending out more obviously than you're collecting in principal because these are interest-only period loans with a P&I following. So you're lending out, then you start to get repaid eventually. And the repayments, because we're scaling these loans out um, like higher over time, you're not stabilized till a couple years after you actually stop increasing the amount of loans lent. Now, if we put these all at, let's say, 1, you can go to the visuals. Now, okay, so you can see now the principal repaid actually surpasses the lent amount a little bit, and then it kind of stabilizes. And this is because it kind of gets weird because there's interest only periods here, so you gotta there's quite actually a lot of logic going on. And we've got a ton, like I said, there's 7 tabs with over 800 rows each that account for what's happening just with this logic here, which I went through in detail. That's the first couple weeks of this video series. So I think this makes sense. I like this. Let me undo the assumptions back to how it was because that was a cool curve. Let's do 1, 3, 5, 7. So let's do type. So let's see what this looks like in a type 2 situation. Type 2 is now interest only loans. So we're doing total outstanding of this one, total outstanding amount, and interest earned. Type 2. And we already got our months in there, that's fine. Okay, so type 2. This is less complex, it's just interest only happening. So you kind of just scale up. What's our assumptions? It's just doing 10. And and the term's only for 1 year each. Which you could change this. This could be less than a year. This could be like half a year. So there's 6 months. Oop. And then you could see, so you're lending, then you get repaid. And then when the term increases, now you're going back up. And now you're stabilized lending out and you're receiving the same exact loan amounts. So this is cool. You can still see what your total essentially long-term balance is versus interest earned. Let's do disbursements versus repayments for type 2. And then type 3 should be kind of interesting at like type 1 because it's principal and interest only. So lent amount, and then repaid collected amount for type 2. This. I think that captures kind of what is really happening in the long term. Okay, interesting. Uh, monthly loan disbursements. So we're dispersing and getting back is exactly what we're dispersing. So that makes sense how that is. It's not, it's kind of doesn't make a lot of sense. This looks a little bit clearer, but this is because you're doing, this is P&I versus interest only. Um, okay, let's do our third type, and then I'm going to do a consolidated as well, and then we'll go to maybe loan counts and go from there. So we got loan type 3. We're doing outstanding loan amount first, okay? Outstanding interest earned. Got the months in there. Okay, so this is even a smoother curve than up here because there's no interest only period, so it's definitely a different shape. This is kind of down and up. This is kind of like a upward curve. And then we'll do this number. So lent amount, type 3 versus principal repaid. hold on. Oh yeah, yeah, okay. So the amount you're lending per month is static because the assumptions are just the same. And then repaid, it's like really a linear line straight up, and then once it balances out, you're getting repaid exactly what you're lending out in total. If we did, again, let's say if we went like 1 a month, 3 a month, 5, 7, 8, in different terms, let's say the beginning we're going to do bigger ones, so 10-year term, 5, and then get down to like 4, 3, oop, and even like 2. That looks, yeah, that's kind of crazy looking. That's really cool. So there's a lot of strategies you can say about like your plans for what you're doing in your loans, the terms, the rate, the amounts, the count can really give you some nice, and you can look here and see like the high level effects over 10 years of what's going on with like how much you're lending out, what you're lending out versus what's being collected. Um, I think this is really cool. This is type 3. And now we do a consolidated. I'm going to zoom out a little bit more here. And I'm going to make these so I can see 2 at a time. This will be a little bit better, easier to digest like this. And these are usually what are used in like a slide deck or something. Put these up here. Welcome viewer. We're doing the funnest part of the model, which is all the data is done. Now we're just doing some visuals to wrap it up. We're about to do the consolidated for loans given out versus the amount repaid and total outstanding amount versus interest earned. And then we'll finally be done with this. It's been about a 5-week project. Get this up here. All right. And then it'll be interesting also, we can overlay net cash flow across these to see like the net, like what's the actual production of this operation. Okay, so consolidated, we'll do the same chart type. Select our data and we'll just go total outstanding, consolidated. Interest earned per month. So interest earned against lent amount. And it's crazy how much logic goes into figuring this out. It's really okay. So this is within. I need to make this a little bit thicker. Line thickness. Let's go a little bit thicker and make it black. So 2.25 in black. Two. Okay, that's easier to see what's going on. Format. All right, like it. So this is consolidated. So on a full level, you can see what's your outstanding receivables versus what interest is being collected, and then how much you're giving out per month versus what's being repaid. And that's gonna give you what's your net, like this number down here, distributions versus repayments, and that net is kind of what we're focused on here on the second visual. So if we go select data, we could do, let's just do, we've got it right here, loan disbursements. Well, hold on, so what lent amount? Let's make sure that we got to keep the labels the same. So lent amount versus principal repaid. Okay, yeah. So this looks kind of wacky, but it's because my assumptions are a bit. I just put some kind of crazy assumptions here for the loan terms and the loan amount added. Let's do a static loan term of like 6, or no, let's just do 10-year loans. Something that's actually realistic, and then the loans added is fine. Let's say the interest only, yeah, their term is usually 1 year or less, so let's just put 1 year here on average. And then term on these can also be 10-year. Thanks, Mr. Patel. Glad to hear it. And yep, I'm really like this model is one of the craziest, most complex things I've ever built ever. And this loan stuff is always difficult, like scaling into it, figuring out all of the different metrics. Um, okay, so we got consolidated. We're gonna get into loan counts. And then we're getting close to the end of the thing. It's been 5 weeks. So loan counts, probably some kind of chart like this. And we probably can do an annual one for here. So we'll do ending customers. Yeah, this will show customer breakdown by type. So we can do that. Type 2. And it might be interesting to see the revenue generated per each type as well. So this is, we need to put this on an annual basis. So this is one, these are years. Annual, annual, annual. So what's, trying to figure out what's the problem here. These, oh, I guess that's fine. Let's just make it font bigger. Put 12, 12. 18. And then we'll do, so here this is aggregate count. Let's do a stacked column. There we go. So you can see customers by type, what the makeup is of each one, and that can be changed depending on what you name them. But these are interest only with, or interest only period with a P&I, interest only, and P&I only. So this is year ending loan count by type. And then what do we want to? We could add revenue, total revenue. Let's see, what do we do up here? We have not done revenue by type, so let's do a different chart. We'll do we're gonna have to actually consolidate this. So if we go to our annual down here, we've got revenue type 1, revenue type revenue type 3. So interest plus origination fees is revenue. Here's type 2. Now we can pull it. Do revenue, we'll do stacked revenue by type. Okay. Kind of need to make all these fonts a little bit bigger. Eleven. Okay, so you can see the loan counts and then the revenue earned by each type. I think that's useful. Let's change the title here. Let's add. So this is, and the types will never change because the logic is literally built in and hard coded. So this is going to be interest plus P and I. This is interest only. This is P plus I only. Welcome. Hey, we got 3 viewers in here. Nice. We're just doing some visuals, finishing up the lending model. This is actually kind of the most interesting part of doing these things. Interest Only period plus P&I. All right. There we go. So you can kind of see. So type 1 is always interest only plus P&I. Like there's no, that's how it's configured and that can't be changed. That's, the logic's hard coded. All the assumptions can be changed for what drives them. Uh, but that's how it works for that type. This is always interest only. This is always P&I only. Okay, do we want to do any other visuals? We got operating activities, costs. Oh, cash flow. So let's see. We can do we can do cash flow and cumulative cash flow. So we'll do, if you are on a monthly. Uh, so this is the loan less the startup costs. I just want to make sure I'm doing the right column. So yeah, we could do this. Cash flow after tax. And then cumulative. And this is before equity. So it's just literally the raw operations of the business less any financing. Here's the month. Okay, now this, because of how the assumptions are set up, we're going right to the bottom. Uh, and that's just, let's see, let's adjust the assumptions a bit. So if we make the terms shorter, I think that we'll see more repayments. But really, I mean, these are completely arbitrary. Whenever, if someone's using this, they're gonna go in just like all my models I build. They got to go in and put in their own assumptions for what makes sense for them. These are completely random. I'm just gonna try to show a positive cash flow, so I think I need to reduce these. Interest rates are already pretty relatively high here. We're still in the negative. Now, if we do a exit and essentially sell all the loans at the end, we're not going to see. Okay, so this is right because this is just doing the operations and not. This doesn't include exit. So this is operation cash flow, not including exit value. So your cash position, you've got all this equity, is funding all this. You go down, you're starting to make money back, and then you also have at the end of this year, what's our consolidated balance of loans is like 42 million, which is an asset. So and that's greater than this. So let's put that on this chart too. So if we add, this is monthly. If we add the consolidated outstanding loan amounts, that's actually showing the offset where that value should be offset against the net negative cash position. So that's cool. That and let's do some formatting here to kind of make this look nice. So make it a bit thicker. Make this one black, and we're gonna do a marker on it. Diamond. That's not an annual. We probably don't want a marker. Undo. Just make it thick. So outstanding loan amount to here, line, and line. Okay. Loan receivable. This is outstanding loans owed to the company or whoever's giving out these loans. So this is an asset. This is the, and you can't really see this middle line. I'm going to take that out, honestly, because it's not going to be visible what happens per month on this basis. Let's take this one out. Really, you want to see the cumulative effect of the operation. So how much cash it took to get lend all this money out, and then you're starting to get money back finally here versus how many outstanding receivables you have. Now this needs to be thicker, 2.25. Now the other number is we do want to see cash flow per month, but without anything else. So, or maybe like with loan activity or something. Let's just do, so this is cash flow after taxes. And the amount per month. And then let's take away the exit. Wait a second. Hold on a second. Hold on a second. This 19 million. So what number are we using for this cumulative cash? Because that shouldn't. Yeah, this is positive. So hold on. This number should match. We might be offset by a month. Yeah, we are. Okay, let's go all the way to year zero. Hold on. So rethink this. Because when the exit happens, essentially, if we're doing an exit, the receivables are collected, or that's the value of the terminal. That's like how you're set what you're selling. So when that happens, this goes away, and that's the difference between the two right here. Now, if we remove that, I think I'm going to keep the visual just like it is. Now you can see, well, if we sold this, then this would go up to where it was. But this is the real thing I wanted to see, the monthly cash flow over time. That's operational cash flow per month. We don't need this. We don't need this. Loans receivable. No, we don't need that. It's defined down here. Okay, so that's cool. Operational cash flow. This is not this. This is cumulative cash flow versus outstanding loans. We don't need to put that. And this negative is defining what our equity needs to be 25 million 230, and you can see that's where our minimum is. So we're saying to operate, we need at least that much money. The resulting distributions here. Well, now we're real far. We're not actually getting to a positive cash flow until year 7 based on those new assumptions I put in. Negative IRR for the project. Now, let's see, how can we change this around a little bit to get a positive situation? So the good thing is everything's balancing and nothing's out of balance. So that's good. All that logic is working, which is the most important thing. Um, so we want, see, this doesn't really matter. This is kind of net zero. Oh, here's why. We're not adding a bunch of loans till the end. So let's just move this to 10 and this to 10. Let's see what we look like now. Okay, bigger bows. Distribution now in year 5 we're positive, which makes sense because now you're getting loans paid back sooner and you're not taking more loans out, or you're not lending out more loans in the future versus what's coming back. So it's really cool. Like when you start to change these things, you can see the effect of trying to do a bank or a loan business, or participating in a lending club type of situation over the course of 10 years, what it looks like. So, man, I'm so happy with how this is working and just all the logic. And this is like turning chaos into order, is what we're doing here. And this is something that's really hard to model, and we've done it. So, I'm trying to think if there's anything else I want to put in here. I'm going to add an index page to the template, definitely, which will just explain what each tab is about. I'm not going to do that on the stream though. We got our control, explains financing, funding sources, start year, exit if applicable. Now if we put the exit in here, now we're in a positive internal rate of return. See that? I like the yellow here. This is nice, this color. Um, Cash flow. Do we want to put any other metrics in here that are relevant? Year-ending loan count by type, revenue, all the different interactions of what's going on with the loan types. I don't know if I want anything else. I would be open to suggestions. Anyone would see this video in the future as well, for things that could be interesting to show on a chart. Oh, so we can show head counts of the sales reps and customer service reps. That's kind of important. What's up, viewer? We're just doing some charts here, finishing up the lending model finally. Hope your day's going great. So, customer service, we have 6 different types. Oh, for each tier. And then that's the total. So let's do customer rep head count. and that's going to be this. Because this scales, we're doing, so if you were like a bank, you would want to know how many customer service and sales reps you have, which is driven by a ratio of how many customers or loans are added per month and the total count of those. So sales reps. Now what I'm seeing is this actually business is very capital intensive. Obviously, you need a lot of money to be able to start doing these kind. Well, I guess I mean you could do very small loans on like Lending Club, but if you're trying to scale out and support a entire business, um, it's very capital intensive. Like we're getting IRRs around 7, and I haven't really put in very many operational costs at all. So, and we're just doing revenues, interest revenue, and origination fees. Um, let's see. What was I gonna? Oh, let's put some values in here. So let's say customer support. You could do each rep can handle 10 customers existing, just so we have some numbers in there for both. Okay, that's good. Um, I mean, you can see here you're actually not having any positive cash flows till year 5. But then once you start getting them, you know, and then you've got a bunch of receivables, you're in a pretty good spot. And this is where you can really see when like the financial collapse happens in 2008 and when nobody can pay back their loans. If they can't pay back their loans and the banks don't have operating capital to lend out, it you know, because they usually run fractional reserve and there's not actually as much cash in the bank as is owed to everybody. That's why they got to do stress tests. Um, you know, that's just it's got to be managed well. All right. I really love this whole thing. I love everything about this model. It's gone. The result is better than I expected it would be. The biggest thing I was worried about was the loan types. Like if I was going to be able to scale that out and do dynamic P and Is over time, and we're treating essentially each monthly customer cohort like a SaaS business would. But the activity that happens while they're essentially a customer or AKA they have loans out is based on what happened with a loan, not just like a monthly account value. It's interest and principal every month, depending on how this is all structured. Uh, and if you want to see the matrix tabs that are doing this, I mean, look over here. This is just the first one, and we're tracking everything about the cohorts by month and then aggregating it onto a level for each of the different loan types. The most complicated one was the interest only with P&I after, trying to figure out how to make that work. Figuring out all the month-end balances, when's interest only happening, when does that stop, when does P&I start, and that all is dynamic based on the loan counts and when the loan counts happen. Um, and it has to keep doing all of that over time. And it has to know the logic is smart enough to know the age and life of each cohort, like how long they've been around, because that's all going to affect the repayments and um, principal interest, all of that. Uh, the interest only one was probably the easiest because you just do a balance and an interest only period. which is not too bad at all. But the rest, you can see here we're at like what, 1,000 rows of logic for to figure out the interest of all this. Still going over more. I mean, it's just a lot, and all this logic is necessary. I don't know any other way that this can actually even be done properly and accurately with some, you know, you can back up the assumptions and say, based on doing those assumptions, this is the financial result, how much cash is needed. We got a 3 statement model, monthly and annual. We got executive summary, bunch of visuals, distributions. You can see exactly everything that's happening per month and year. And here's all the assumptions that are being displayed. Oh man, what a model. About 5 weeks. Ugh. So I'm gonna sell this for this template. It's gonna be $75. I'll probably have it up hopefully by the end of the day. I'll do a quick 10-minute overview on the full model, just going through each tab and explaining it. And I think that's about it, guys. About a 2-hour stream today. The next thing I'm going to do is probably something with like inventory. When you're trying to do inventory within the 3 statement model, there's a lot of complexity there that I think people need help with. So I'm thinking about building like a helper tool that just focuses on those um, transactions, like the timing of inventory, the balance of the account over time, if there's payables over time, uh, like the cash needed to cover that. Um, and it's going to focus on what parts of this 3 statement model all of that affects, which is going to be obviously inventory, cash, accounts payable, if you're not paying for it all up front. And I think that's about it. So it was great to see everybody. Had a couple more viewers today. Hopefully every week we get a little bit bigger. I'll be doing the same stuff as just different models every week. And see you guys on the next one.